For a long time, silver has been in a weird spot. It's not fully seen as money like gold, and it's not just another industrial metal. It's stuck in the middle, which makes it pretty misunderstood and vulnerable, especially when the economy gets shaky. Right now, everyone thinks silver is just boring. Its price isn't doing much, it's not making headlines, and it's been pushed to the background while everyone's talking about tech stocks and bonds. People call it range-bound or unloved. This isn't just talk. It's a sign that big money isn't paying attention. But be careful. This quiet isn't what it seems. Historically, the calmest periods for silver often came right before a major shakeup. When the price barely moves and people lose interest, that's not a sign of balance. It's often when hidden stress is building up. Think of it this way. A market can look stable on the surface while its inner workings are getting more and more fragile. To really get this, you need to understand the difference between silver's price and its structure. The price you see on your screen isn't set by people buying and selling actual physical silver bars and coins. It is set by paper contracts, futures, and options. And there are way more of these contracts than there is physical metal to back them up. So the calm we're seeing is in the paper market, not the physical one. Meanwhile, the real world still needs silver. Demand from industries like electronics, solar energy, and medicine is growing every day. And let's not forget, when people lose faith in traditional money, they often turn back to silver as a safe haven. These two powerful forces are constantly putting pressure on the actual supply of physical silver, even if the paper price isn't moving. This creates a huge disconnect. On one hand, you have the financial market signaling that everything is fine and there's plenty of silver to go around. On the other, you have the much smaller physical market, which is tight and sensitive to any disruption. The longer this gap exists, the more brittle the whole system becomes. The risk isn't going to show up gradually. It will stay hidden until a small shock forces everyone to ask, can you actually deliver the metal you promised? We've seen this movie before. Big blowups in the silver market aren't just about prices crashing or bubbles popping. They are liquidity crises. They happen when the promises made in the paper market can't be met with the physical metal available. The crazy price swing isn't the cause of the crisis. It's the symptom of a broken system. And here's the key. These crises don't start with panic. They start with overconfidence. Confidence that you can always get what you need, that contracts can always be rolled over, and that no one will ever actually ask for a large delivery of the physical metal. This confidence works until it doesn't. When everyone believes it without question, it becomes the system's greatest weakness. Today's silver market has all the classic signs. It's dominated by financial players who are just managing price exposure, not trying to own the metal. They think about risk in terms of dollars and cents, not in terms of whether they can get their hands on the physical product. Everyone just assumes the market will keep working like it always has. Taking this lack of stress as proof that no stress exists is a huge mistake. In reality, the absence of visible stress means the risk has been bottled up, concentrated in parts of the system that rarely get tested. It means the market is built for efficiency and leverage, not for resilience. And it means that when a real test finally comes, the adjustment won't be smooth. It will be sudden and chaotic. So, the silver market isn't stable. It's just quiet. And in finance, quiet is rarely a sign of safety. It's usually the calm before the storm. The real question isn't why silver is so calm today. It's where all the pressure from this manufactured calm is building up, and what will happen when the market is finally forced to face it. To understand how a breakdown in the silver market actually occurs, it is necessary to abandon the common image of a simple price collapse. Silver does not fail in the way an equity index fails, through a continuous process of selling pressure and declining valuations. It fails structurally. The critical events do not begin with falling prices, but with the inability of the market's internal machinery to continue performing its basic functions: clearing, settlement, and delivery. The modern silver market is, in practice, a layered financial construction. At the surface are futures contracts, options, exchange-traded products, and various forms of unallocated accounts. These instruments are highly liquid, heavily traded, and form the basis of the price discovery mechanism. Beneath them is the physical market, which is comparatively small, slow to adjust, and constrained by the realities of mining output, refining capacity, transportation, and inventory management. The two layers are connected by confidence rather than by strict one-to-one backing. In theory, this structure is efficient. Most participants have no interest in taking delivery of metal. Producers hedge future output, consumers hedge future needs, and financial institutions intermediate between them. The vast majority of contracts are closed or rolled before delivery. As long as this behavior remains consistent, the system can support a volume of paper claims that is many times larger than the volume of available metal. The problem is not that this leverage exists. The problem is that it is treated as if it were irrelevant. Every layer of the silver market assumes that the layer beneath it will function normally. Funds assume that exchanges will clear. Exchanges assume that clearing members will perform. Clearing members assume that liquidity will be available. And all of them assume that, if necessary, physical metal can be sourced in the required quantities. This chain of assumptions is rarely tested in full, because doing so would require a coordinated demand for delivery or a sudden withdrawal of balance sheet capacity. A breakdown begins when one of these assumptions fails. It might start with something that appears unrelated: a sharp move in interest rates, a funding squeeze in another market, a geopolitical disruption, or large institutional failure. These events do not need to originate in silver. They only need to force market participants to reduce risk, conserve liquidity, or question counterparty exposure. When that happens, behavior changes. Positions that were routinely rolled are closed. Hedges that were treated as permanent are reevaluated. And some participants, for the first time, begin to care not just about price, but about performance. This is the point at which the distinction between exposure and ownership becomes critical. Many participants in the silver market believe they have silver exposure, but very few control silver itself. Their claims are against intermediaries, not against metal. Under normal conditions, this distinction does not matter. Under stress, it becomes decisive. If too many participants attempt to convert exposure into delivery at the same time, the system is forced to reveal how much metal is actually available and how much is merely promised. Because the physical market is small, it does not take a large shift in behavior to overwhelm it. A relatively modest increase in delivery demand, or a relatively modest reduction in the willingness of banks to intermediate, can produce disproportionate effects. Inventories that appear sufficient on paper can become functionally unavailable if they are already encumbered, pledged, or strategically reserved. What looked like liquidity can vanish without warning. At this stage, the problem is no longer price volatility. It is market function. Exchanges and clearing systems are designed to manage price risk, not trust failures. If participants begin to doubt that contracts will be honored in the manner they expect, they will demand either more collateral, more margin, or alternative forms of settlement. Each of these responses increases stress elsewhere in the system. Higher margin requirements force liquidations. Cash settlement undermines confidence in the contract structure, and attempts to source physical metal push pressure into an already constrained supply chain. A true silver breakdown, therefore, is characterized by a series of reinforcing feedback loops. Liquidity tightens, which increases volatility. Increased volatility raises margin requirements, which forces position reductions. Position reductions strain balance sheets, which reduces market-making capacity. Reduced market-making capacity widens spreads and further reduces liquidity. At no point is this process driven primarily by a change in the long-term value of silver. It is driven by the mechanics of a leveraged, confidence-based market under stress. It is important to note that in such a scenario, prices can behave in counterintuitive ways. In the early stages, forced selling and liquidation can push prices sharply lower, even as physical scarcity begins to emerge. Later, once the financial structure has been damaged and confidence in paper claims has been weakened, prices can move violently in the opposite direction. The common factor is not direction, but instability. The fragility of the silver market does not come from its size alone. It comes from the ratio between claims and control. The system works only as long as most participants are content to trade promises rather than demand performance. When that preference changes, even slightly, the adjustment is not smooth. The silver market is not a simple commodity market. It is a confidence structure built on leverage and intermediation. When it breaks, it does not break gradually. It breaks at the points where obligations can no longer be quietly rolled forward. And when that happens, the issue is no longer what silver is worth, but whether the market can still function as designed. Ever wondered what could really shake the silver market to its core? It's not always about mining strikes or industrial demand. The real triggers are often hidden in the global financial system, waiting for the right moment. Let's explore the macro-level pressures that could set off a silver market crisis. Financial markets rarely break on their own. They break when stress from elsewhere forces everyone to change their game plan. The silver market is especially vulnerable because of its deep connection to leverage and global liquidity. Think of it like a finely tuned machine that relies on a constant flow of cheap and easy money. For the past 2 decades, this flow has been abundant, encouraging leverage across the entire financial system, from government debt to complex derivatives. This leverage is often invisible, tucked away in collateral chains and off-balance sheet structures. When everything is calm, it looks stable. But when the financial weather turns, these hidden connections become channels for stress. So, what happens when the river of global liquidity starts to dry up? The first reaction from big financial institutions isn't to rethink their long-term plans. It's to cut risk and cut it fast. They sell what's easy to sell, not necessarily what's weakest. Since silver is heavily traded in futures and ETFs, it often gets caught in this initial wave of de-risking. This can create a false signal, making it seem like silver's price is falling because of its own fundamentals. In reality, it's just being used as a tool to manage a balance sheet under pressure. At the same time, the banks and trading houses that keep the silver market running face their own squeeze. As their own funding costs rise, they become less willing to hold inventory or take on risk. This isn't some grand conspiracy. It's a natural, simultaneous reaction across the industry driven by internal risk management. This makes the market thinner and more fragile, less able to absorb shocks. Another huge factor is the US dollar and real interest rates. Historically, when real rates go up, holding a non-yielding asset like silver becomes less attractive, putting downward pressure on its price. But there's a twist. If rising rates happen at the same time as stress in other parts of the financial system, like government bond markets or banks, the narrative flips. The conversation is no longer about opportunity cost. It becomes about counterparty risk and trust in the system itself. In this kind of chaotic environment, you see two opposing forces collide. On one hand, leveraged players are forced to sell their paper silver positions to cover their losses. On the other hand, strategic players, like industrial users or even nations, might rush to secure physical silver as a precaution. This isn't a smooth rebalancing. It's a showdown between paper liquidation and physical accumulation, which can create extreme volatility. Let's not forget geopolitics. Silver is a strategic industrial metal, and its production is concentrated in just a few regions. Supply can't just ramp up overnight. Any disruption from trade wars, resource nationalism, or regional instability can have a massive impact, especially in a market already teetering on the edge. It's crucial to understand that the trigger doesn't have to be one single dramatic event. It's more likely to be a sequence of smaller, reinforcing pressures. A funding market tightens, a major bank reduces its exposure, a clearinghouse hikes margin requirements. A big industrial buyer changes its sourcing strategy. Each step seems logical on its own, but together they can fundamentally alter the market's behavior. The defining feature of such a crisis isn't just volatility, it's correlation. Assets that normally move independently start moving in lockstep, driven by balance sheet mechanics, not fundamentals. When this happens, the lines between financial markets and commodity markets blur, and silver gets pulled into a much larger deleveraging event. Eventually, the market reaches a tipping point. The question is no longer about whether silver is cheap or expensive. It's about whether the market structure itself can deliver on its promises. That's the moment when the focus shifts from trading prices to securing physical supply, from financial gains to real-world resilience. The silver market doesn't need its own internal crisis. It just needs to be caught in a system-wide adjustment where liquidity becomes scarce and trust breaks down. Its internal leverage and relatively small physical size make it a natural fault line. We can't know the exact catalyst in advance, but the vulnerability is already there for all to see. Who wins, who fails, and who is not prepared. When market structures are built on continuity, the greatest risk is not mispricing, but misclassification. Participants believe they understand what they own, what they are exposed to, and how their positions will behave under stress. In a silver market breakdown, these assumptions are tested not by gradual adjustment, but by discontinuity. The outcome is not distributed evenly. It depends on where each participant sits in the structure and which form of risk they actually carry. At the center of the system are the bullion banks, large trading houses, and financial institutions that intermediate between producers, consumers, and investors. Their role is to provide liquidity, manage inventories, and absorb short-term imbalances. In normal conditions, this is a profitable and relatively low visibility business. In stressed conditions, it becomes a balance sheet problem. These institutions are not primarily exposed to the long-term price of silver. They are exposed to funding costs, margin requirements, and counterparty performance. When any of these variables move sharply, their first priority is not market stability, but institutional survival. This creates an asymmetry. The entities that appear to control the market in calm periods are often the least willing or able to support it in crisis periods. As volatility rises and capital becomes scarce, risk limits are tightened and inventories are reduced. Market making becomes selective. Liquidity provision becomes conditional. From the outside, this looks like a sudden disappearance of depth. From the inside, it is simply rational risk management under constraint. Next in the chain are the large funds and speculative participants who dominate trading volumes. Their exposure is primarily to price and volatility, not to delivery. Many operate with leverage, explicit or implicit, and rely on the assumption that positions can always be adjusted. In a breakdown scenario, they are typically the first forced sellers. Rising margin requirements and widening spreads make it increasingly expensive to maintain positions. The decision to exit is not driven by a change in outlook on silver, but by the need to reduce balance sheet stress elsewhere. Then there are the vehicles that are widely perceived as ownership instruments, particularly exchange-traded products and unallocated accounts. Under normal conditions, these structures provide efficient and liquid exposure. Under stress, their legal and operational design becomes critical. Some allow for physical redemption only under specific conditions, or only for specific classes of participants. Others rely on chains of custody and sub-custody that are not transparent to end investors. The risk here is not primarily that these structures fail, but that their behavior diverges from what holders expect at precisely the moment expectations matter most. Industrial consumers occupy a different position altogether. For them, silver is not a financial asset, but an input. In stable markets, they operate on just-in-time inventory models and long-term supply contracts. In unstable markets, their priority shifts from cost optimization to supply assurance. If confidence in market delivery weakens, they have strong incentives to secure physical metal directly, even at unfavorable prices. This behavior, while rational at the firm level, can accelerate stress at the system level by pulling metal out of circulation. Finally, there are the participants who hold silver not as a trade, but as a strategic asset. Their exposure is not to price movements in the short term, but to the integrity of the system over the long term. They are not dependent on daily liquidity, and they are not forced to respond to margin calls. In a breakdown scenario, they are not necessarily the ones who benefit most in price terms in the early stages, but they are the ones least exposed to forced decisions made under pressure. The critical misunderstanding that runs through the system is the nature of liquidity. In calm markets, liquidity is treated as a permanent feature. In reality, it is a conditional one. It exists as long as balance sheets are available and confidence is intact. When either of these conditions is violated, liquidity does not decline gradually. It disappears selectively in the places where it is most needed. A silver market breakdown, therefore, is not simply a test of valuation models. It is a test of institutional design. It reveals which structures were built for efficiency and which were built for resilience. It exposes the difference between having exposure and having control, between being able to trade and being able to rely. Most participants are positioned for continuity. Their strategies, risk systems, and assumptions are optimized for a world in which markets always open, contracts always roll, and settlement is a formality. The risk is not that this world changes slowly. The risk is that it changes abruptly, and that the adjustment path is dictated by constraints rather than by choice. In such an environment, the most dangerous position is not being wrong about the future price of silver. It is being wrong about the nature of the system in which that price is formed.